There we go. So look, short version. I want to go through this PDF until we get to like the S&P Open. Again, you guys are going to be watching crude oil. Those of you guys that trade it. I really would love to see trades from you guys today, and we'll go through your pictures and your rules and the things that you guys are going through. So, three main skills: chart reading, trade entry, trade management. Once you get those three things down, you're done. There is a fourth component on here, which I find to be the most difficult component in trading. You guys can tell me if I'm wrong or not, but waiting for the best setups possible. That's one of the hardest things on God's green earth to do. And everybody can go back and read your charts and say, I shoulda, coulda, woulda, right? I mean, 2020 historical vision is pretty easy. And that's why we put together rules and checklists, because you want the pre-set up look to look the same every single time. And part of that, obviously is trigger lines, and then the trade entry precision comes from where the Fibonacci areas are. And then ultimately trade management is going to set you apart. So I'll put this PDF in here for everybody if you scroll up just a little bit, if you just came in. And one of the things that I know Mark talks about it a lot, and I'm just going to kind of regurgitate some of the key concepts, but it's really important when you guys look at a bar of data, you're asking yourself the question, where is this bar relative to the trigger lines? It's literally going to make your decision on whether you place a trade or not for you. If the price bars are completely above small triggers going up, you better put that trade on. If they're completely below wide small triggers going down, you better put that trade on it, assuming the rules are true. And it really is just that simple. And I want to make sure you guys don't have any questions about this, because again, it's not that you can't trade when the price bars get below the small triggers. That's not what I'm saying. What I'm saying is that there are certain points in the market at tops, bottoms, termination conditions, where I think most of you guys who are waiting for trend trades, and again, let's take this chart as an example. As a new user, right, this is going to be your trend trade right here. Let me take a picture and I'll document it a little bit. So bear with me here. So look, as a new user, tell me if I'm off base here. This is going to be your trend trade right here. I'll put a little arrow, put a little square on it, because both triggers are going up very, very strong. Everybody okay with that? I mean, that one's pretty much straightforward, nice and easy. I don't think anybody has any trouble with that. The trick is for you guys, and look, you guys are going to go through a process of figuring out who you are as a trader and what you can get away with and what you can't get away with our software. But when you have some type of support that's so overwhelming at the bottom, right? Pivot stop outs, 1-to-1s, fibs, blah, 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 whatever the case is that creates this bottom. This is the extra trade that you guys are going to get before the trend trade. And again, this trade comes in the form of sometimes a momentum trade, or sometimes it comes in the form of a high volume area trade. But this trade is very, very powerful, number one, because it has a lot more profit potential. And that's really, ultimately there's two things that are going to make a difference in how much money you make. How much profit potential is in each trade, and how many opportunities there are per market. And, again, look, that's why, we like watching the NASDAQ futures, and we would never start anybody out in the NASDAQ futures because, it can be insane as far as speed and things of that nature. But Once you get these processes down, you'll start, adding on trades to your plan. Again, as we go through the trades, and I won't beat this up too bad, but uh, hopefully everybody sees, the vision. This is every trade you're ever going to do, period, or should do anyway. Let me rephrase that. You're not going to do all of them, but and again, when you look at the large triggers, you want to make sure that the bars are completely above or below them. Does that make sense? And that's the only trick there is to a trend trade. Did I not run into something, and are the bars below the large triggers? And I think sometimes people have a hard time when the small triggers are on there, that they kind of lose sight of what the large triggers on the bars are doing. So there's two phases where you guys can make money. Pretty much dip your hand in the well and take your money. Number one, when everything's screaming your way, both triggers, and you get your trend trades. And then the second is after a top or bottom with lots of momentum. And everything that you do is going to be predicated on trigger line look. And we can go back 10 years of videos and pictures and everything else, but it's a function of two things. Where's the area and what are the triggers doing? Where's the area and what are the triggers doing? And again, look, this is a good example of what I was telling you earlier. And again, technically, maybe there was a trade right here. But, again, whenever you get a really good bottom, the most money you're going to make, and again, look, they don't all go, but the most money you're going to make is the sooner you can get in after the bottom, you'll make more money. And again, you'll get the trend trade after both triggers roll, but it's this early money, I think, where most traders, you guys tell me, give me some feedback. When you look at your charts, you're like, damn, waiting for that trend trade, I'm missing all the money. Do you ever say that to yourself? And again, there's nothing wrong with, waiting things out a little bit. And again, sometimes, look, people will start selling the small triggers and they'll lose and, they'll get a little puckered up and they won't take the second trade. And again, look, I put this one in here. Again, I think it's a great example. If you have a really good top, which I think we did up here, then, you may get a first opportunity here, but it may fail because it was the first stab at it. And then, you get a second opportunity almost at the same spot, probably, that ends up making a whole bunch of money. So, again, when you incorporate this thought process of adding in extra trades, you have to be good on your management, which we're going to go through management here because I think it's a really good thing to go through. Terminations and management of your trades. As long as you have those two things mastered, you almost can't screw it up. You can. People still find a way, but as long as you have terminations correct and management correct, and I'm going to tell you what, managing a trade sucks because you're so mentally, or at least in the beginning, because you're so mentally, emotionally, and you've worked so hard and you've waited so long for that trade that you really want it to go all the way. And when the management opportunity presents itself, you have to really kind of swallow what you want, take the exit, and wait for the next trade, which we're going to go through some of that. So we'll take a look at that. But again, I think trigger lines ultimately is your first most important thing. You guys have seen, or maybe you haven't, I don't know if you guys have been watching in the other chat room or not, but I've been playing around with building out some of the indicators on TradingView, which no, they're not ready for you guys yet, so don't ask, but I promise when that time comes. And we can't do all of our indicators. I'm actually having my programmers write up an opportunity for us to get fibs in here, but we did triggers and one-to-ones and trend bands and the MACDs, which is still a pretty good start. And again, I brought this out not to say, haha, I've got something you can't have, but I wanted you to just kind of see, even without the fibs, which again, those of you guys who've had fibs for 10, 15 years, you know better not to trade into fibs. But as long as the trigger lines are screaming in your direction, you're going to get a pretty good opportunity to make some money. And Mark and I are actually building out a trading plan for a simplified version of TradingView. And the short version is, yes, Josh, but it's just an indicator. Yeah, it's just an indicator that runs on TradingView. I haven't done everything that I need to do with TradingView to be a indicator publisher, vendor, slash whatever. So there's some work that needs to be done. But look, our plan is really simple. If the triggers are going down and you break through a mid band, then you sell the mid band on a pullback, right? Or we even wait for a close below the triggers. That's it. Just mid bands. Mid bands or outer bands, and that's the whole trading plan, which is not dissimilar to what we're doing here. This is the difference in having fibs and not having fibs. And I don't know about you guys, but I'm of the opinion a great trader can probably trade anything and make some money. Because if you're a great trader, you find a way to make money. When you're not a great trader and you're working on becoming a great trader, you really need every advantage that's possible to you. So when you can look at a chart and say to yourself, because of the trigger lines, oops, this is not one of my pictures, but because of the trigger lines and nothing else, this Fibonacci resistance should hold. And because the trigger lines didn't get below this Fibonacci should hold. It's a very powerful, simple thing that when you have this condition, you have to wait. And again, as I said, waiting is probably one of the harder things. And look, these are the same pictures that you guys go through with Mark. So hopefully there's nothing that's, overly new to you guys. If there is, again, you guys tell me. But and again, I'm talking about reading your large chart first, of course. You'll find that when you get to resistance, the market can put in a bounce. And you guys have seen this enough times. When you get to support, the market can put in a bounce. And when you get to the very, very last line of resistance on your chart, the edge of resistance, you have a more powerful opportunity. Here, let me save this to a spot where I can blow it up, because I really think this is very important stuff. When you get to an area that's so freaking powerful, and again, when I say it's powerful, what do I mean? Well, it's the edge of Fibonacci resistance. And when I look at where the small triggers are located relative to the large triggers, they're physically below. Remember, when we're doing a trade, we want the small triggers on the correct side of the large triggers. That's kind of trade 101. So, again, once you actually have this top and your triggers start to roll over, you have really two trade opportunities. There's one right here, which is kind of harder to see. Do you see that little tail? That's your first little pullback to your triggers, and that's where maximum money is going to be made because of this top. And then your secondary trade is going to be right here. And, there's another concept that we talk about a lot, which is a good top or a good bottom. And whenever you have a good top, meaning multiple divergences, correct trigger lines, strong triggers, the market has a tendency to break these next Fibonacci areas. Now, that's a really good first profit target. But you have to be on your toes after a good top or bottom to say, I need to keep taking trades until these triggers give out. That's the short version. All right, we'll move on. Anyway, termination is when we stop going long or we stop going short. And not every Fibonacci support or resistance is a termination condition. And I think this is one of the things that it takes, I don't know, you guys tell me, but it probably takes about 6 months to get used to the idea that you can go short and even hold through Fibonacci support if the top is good enough. You'll see some traders that do it and they make really big trades. You're like, how do they do it? That's it. As you guys know, one-to-ones are also a very powerful termination condition for us. The bigger the chart, usually one-to-ones, I'd like to say that they catch the overrun of a Fibonacci break. They do that a lot. But again, everything that we do is predicated on one simple concept. Where are the trigger lines at the time when we touch, or when price touches, I guess I should say. When price touches the one-to-ones, what are the triggers doing? That's all. Where are they at? What are they doing? And that's all you really need to know. And, again, in the beginning, I don't think it's difficult to see that there are no triggers that are past the one-to-ones. This is going to be very important for you guys because it's going to lead into one of the next things that you guys want to know more than anything else. I mean, I get asked this 20 times a week. How do I know when I'm going to have a great momentum trade? And, the difference between termination and momentum trade is completely in the trigger lines. So when we get to it, not now, but when we get to it, the only difference between termination at one-to-ones and a momentum trade you should take is the location of the small triggers relative to the one-to-ones. Does that make sense? So a momentum trade would be these triggers are way down past the one-to-one, and then you would do a short. If the triggers are physically above the one-to-one, you stop going short. Now, you don't necessarily go long right away because obviously there's a lot of crap here, but you stop going short. And that's all you need to know really with terminations in the beginning is when do I stop? And, ultimately the market, if you wait long enough, the market is going to give you the opportunity to go long. Right? And I know, some people want to catch the bottom, and I got that. But again, the conservative approach, now, I want you to think about this. How many triggers are past the midband right here? And look, this is the answer to pretty much everything that you guys are going to do. Where are the triggers? Are they both well beyond the midband? And the answer is no. So it's still a termination spot. And it causes a lot of trouble because, as a new trader, you're going to see that both triggers are up. And you're going to say to yourself, God, it's got to be a trend trade long because both triggers are up. And the idea behind termination conditions is if any resistance doesn't have triggers beyond it, it will be a resistance. It probably will at least bounce the market, if not hold. When we move forward, you'll see that we've got a different scenario here. Remember when I talked about having price bars above your small triggers? This is what we're talking about. And when we look at the midband itself, this is the point right here where the triggers are getting above the midband. And again, we're hoping for a pullback so we can do a trade, of course, which doesn't always happen. We don't always get a trade just because there's a move. So it's, again, Just depends. The small one to ones, large one to ones, they're all kind of the same thing. Small one to ones don't make that much of a difference in the world. They're good first profit targets. They may be good for targets at the edge of fibs. But don't get too wrapped up in the small one to ones, especially on crude or S&P. You can take some money there, but they don't always reverse the market as well as a big one to one. In what sense, Rob? Just above and wide would create a trade. Just above and not wide is not a momentum trade. Is that what you're talking about, the momentum trade? How do you get into a trade when you don't get a pullback to an area? You don't. So, Spice, think about what you're saying. My rules aren't true. How do I get in? You only have two choices. You write a new rule, or I do have a rule for you, or you don't. I don't mean to go off. I know I don't want this to be too confusing for you guys. There is one very simple way for you guys to get in if you're not able to get a trade. Man, hang on a second. I need to pull up my NASDAQ trading plan real quick. Because it happens a lot in the NASDAQ. It's like that little bastard just runs off and freaking goes crazy. Bear with me. So, all right. I have a picture for you. And again, I want you to look at this picture. Here, I'll blow it up for you. But this is really the secret. If you don't have another way to get into a trade, again, the idea of adding in I'm going to do a couple things here, just real quick. This is the secret for getting in when there's no way to get in. Ultimately, it's better if you have an area there. Bear with me a second. But we call it a one up, one down. No. You have to have the balls to jump, or the ovaries of steel. You have to say to yourself, the damn thing is running and there's no way I'm going to get a trade. Okay? That's the short version. Spice, that's what you're asking me, right? The damn thing is running and there's no way for me to make any money. So I need a way to get in. This is it. Again, it incorporates the market flow chart, but doesn't have anything to do with the market flow. It's a very simple pattern on your range chart that when both of these, if you use the really fast trigger line configuration, 8325, if you use this configuration and you're screaming in one direction, after a down bar, you can buy and pray that you make an up bar right after it. And the minute you do make an up bar, you control your stop behind it. So ultimately, what you're trying to do is you're trying to really bring in a full spectrum. Obviously, if you can get an area to do it from, the better, like a one-to-one. But even if there was no one-to-one here, you could still do this trade because we're outside the outer bands, we have wide, strong triggers, and the market usually goes one down, one up, and then finishes the move. So this is the answer to your question, and doesn't have anything to do with the dots or the lines on the bars. Nothing to do with market flow dots whatsoever. Everybody okay with that? It's simply one bar down. I hope that the momentum carries me through to Fibonacci resistance, and that's it. That's your only way that I have found that is very successful at jumping into a very strong trend. Mark's going to kill me. Well, absolutely. You have to have no termination. You have to have room to the target. And even in my plan, ultimately, I say, and I'll read it to you just so you can, right? With the one up, one down trades, it's better to have an area than not have an area. And, here's an example where, let me take another look. I'll give you guys these if you want, but this is the same logic. Again, I always say that it's better if you have some type of Fibonacci area with the one up, but you're selling one up with the hopes that you continue down to your target, wherever your target is. If you have an area, it's better. But if you've totally broken through and you're on your way to an area that you should probably get to based on all three charts trigger lines, one up, one down is the way to go. And the other part of it is too, I use this a lot in the NASDAQ for management. So I will post them. So look, assuming you're short at some point, again, look, everybody say, yes, I understand. This has nothing to do with the dots and the lines and the bar. It's triggers and location of the triggers and location of the bars relative to the triggers. The fact that there's dots on the bar has nothing to do with what we're talking about. So again, this is the type of situation where, let's just say, hypothetically, you're watching the NASDAQ or the S&P or crude oil, and the damn thing it broke through and you didn't have a trade on your other charts. And you're saying to yourself, I need to get in because I know where it's going. And I feel very confident that it's going there. One up, you just sell it and you hope for the down bar. Again, if you've got resistance areas and stuff, it makes it a lot easier. But I'm saying once you've broken past and you've totally missed it, let's say this happens in like 6 seconds. And you're like, damn, I missed it. It's going too fast. This is your only way to get in that I have found that is very consistent. Now, these are also the triggers that you want to use for momentum trades. So, they all kind of go together as far as trigger line looks. Once you get the trigger line looks correct, everything else takes care of itself. I'll post that other trading plan if you guys want. I'm sure most of you have it already, but there's a lot of really good examples in there, so I'll post it in just so you guys can have it. But again, I'm not really trying to go through NASDAQ stuff with you guys. Again, we're talking about terminations. This is another one of those terminations that, again, you hate to get out, but you have to. If you have 3 divergences on your small chart, party's over. There's no reason to stay in and lose a bunch of money. It doesn't, 80% of the time it works every time. Now, when we talk about trend trade rules, again, we won't beat this up too much, but short version is if you have a good top or bottom, it's preferable. So I think a breakout of a Fibonacci support or resistance also counts as a good top or bottom if you've got strong triggers. And again, number 2, make sure you don't trade directly into something that's going to ruin your day. And then number 3, get in on some type of pullback. Every trade's the same, guys. Whether it's momentum, whether it's HVA trades, whether it's trend trades, it's strong triggers with a high momentum look and a pullback to something. The only difference between a trend trade and a momentum trade, let's see if I have momentum trades in here. while we're at it, just for fun, you'll go back and you'll start studying your chart. If you have you know, the desire for this, go back and start studying what your trigger lines are doing on a range chart. And when they're going down, the one up, one down works. When they're going up, the one down, one up works. Sometimes you have to do it twice because they're really rude, and they'll get you. Um, Hopefully, you don't put your stop at Fibonacci support. But anyway, you'll see this a lot. And the other thing about this one up, one down business is it allows the market to take you out of a trade instead of you getting yourself out. Speaking of the market, I wanted to take a look at it here. Oh, man, that's ugly. Okay, live market. You guys answer the question. How many triggers are above the midband right here? Is there enough triggers above the midband to go long? And again, some of you guys are looking at this going, yay, I'm going long. But, there's two questions to ask yourself. What happened down here at the bottom? Was that a good bottom? Not really. It didn't happen from anywhere. Not that we won't go up. We may go up some. But it's not a great bottom. And what will happen eventually is they're going to horse around. And then they're going to end up, even maybe if it's from resistance, then they'll come down here and they'll finish this move to a fib support. And then once they do that, usually we get a good bottom. Or if we get a breakout. And again, look, you're not going short, right? Hopefully. But again, this is not an ideal long just because of the location of the trigger lines, even though it's probably going to go up to resistance. These are the ones that are short-lived. And again, this is the part in trading where you guys, let's just say hypothetically, you took a long trade. You have to decide when is it time to manage my position. So let's say you took it anyway and you said, I'm going to do it because it's right after the open and they're probably going to move. This is the part right here where management is probably going to get you out of your trade. And, again, sometimes they come down and they give you another trade setup. Sometimes they don't. We'll go through management first and then we'll go look at the live market. I don't mind looking at the live market. We'll do plenty of time on the live market. Where did I put my PDF? Here we go. All right. So I wanted to get into, and again, look, I think trend trades are pretty straightforward. I don't want to spend too much time with them, but, they're all the same. Every trend trade is the exact, this is the management section. So I lost my place. Trend trade rules. Okay. Every trend trade is the exact same. It's basically a momentum trade on the big chart. And we call it a trend trade because there's a pullback on the small chart. But if you only had one chart and you only had one look to ever trade, and it doesn't matter what chart you trade, it doesn't matter what market you trade, it doesn't matter what time frame you trade. Everybody goes, what's the best time frame? It's like there is no such thing. They all work, every one of them. The only thing you're looking for without worrying about the market, the time frame, or anything else is this look. Remember when we talked about trend trades and making sure that the bars are completely above the large triggers? This is the one look right here that if you only did this look, even if you lose, life's going to be easy. What's the difference? Strong triggers, an area to pull back to. If this was your 5-1 chart or a 10-2 or 13-2 on the NASDAQ or anything else, this would still be a trade on any chart. So if it's on a small chart, it's a momentum trade. And if it's on a large chart, it's trend trade. And you just have to wait for the small chart areas. So I want you to think about something. Every trade you do is a momentum trade, except for one, if you do high volume area trades. I don't know if you, by show of hands, yes or no, who does high volume area trades? Just curious on where my audience is. Do you guys do high volume trades or not? The lines, high volume lines, we'll get to them. No? All right. And again, high volume area trades are a function of having the correct trigger lines as well. Anyway, short version is let's talk about stop logic. I've said this a million times over 25 years. The initial stop is to be placed where the market should not go. And a lot of this has to do with chart reading, right? You have to be able to look at your chart and go, the market shouldn't go here because why? It's above triggers, it's above areas. So again, when we start off buying or selling or buying, I guess is the case in these two pictures, your stop is going to be above all of the triggers and above probably the one-to-ones. And you don't know if it's going to stop. Sometimes they go a little further and get to the last area, and then they go. But if you're buying or selling at an area, right, which I think is preferable on crude oil and S&P and stuff like that, not always preferable on the NASDAQ. The NASDAQ has a tendency to overrun perfect areas more than any other market. But when you're buying at the perfect spot, you want to make sure that the market has to break the perfect spot before you get stopped out. You don't want to put your stop so close that they're going to come get you. And then once they start making up bars, obviously, that's where we start trailing our stops. And you will find that when you get the up bar, down bar from the perfect spot, if they take it out, it's going to go a lot further. So if you were long and you get stopped out, you're done. And almost without question, 9,000 times out of 9,000 times, as long as price remains below, remember where we talked about where the bar is relative to the small triggers? Because a lot of people say, little fuckers, they got me. I'm going to go long again and again and again because it's got to go up. If you're going to do that, make sure that you're on the correct side of your small trigger lines. Can you guys visualize this? If you were to get rid of the large and the synthetic trigger lines and you only had price bars and small triggers, would you get in if it was red and below the small triggers going down? No, I mean you have to once for a trend trade. That's the rules. But you don't have to get back in and back in and back in until the small triggers are going up again. Anyway, one of my favorite pictures in the world is when all the triggers roll back in your favor again. And you're going to see, when we talk about management, this is the one that's going to irk you probably the worst. Because, man, hang on. Now, I did all my fertilizing and my grass and everything this weekend. I got a little scratchy yesterday out there in the yard all day long. This is the one that's going to irk you the worst because this is the trade where you're going to say, we've broken all the lines and everything's going my way and there's 100 miles to the next resistance. So I should stay in my trade. And again, when these small triggers are crossed against you, and remember when we talked, I'm trying to make management easy for you. Ask yourself where the price bars are relative to your small triggers. And if you get a lower divergence, which will happen down here, where are you in relationship to your small triggers? Small triggers run the show, guys, if you haven't figured it out yet. If you're on the wrong side, get out. Don't lose a bunch of money because you'd probably be long from the area, give or take, right? A couple ticks. And you'd end up with a break even trade, and you'd be sitting there wondering to yourself, man, did they just take me out? And are they going to go up without me? Am I ever going to get another opportunity? And until you get on the correct side of the small triggers, you'll never get another opportunity. Or you shouldn't take another opportunity. You guys hear what I'm saying? And again, this is just simple management stuff that I'm not sure, a lot of people spend a lot of time with, but it's the most important part of your trading plan. Because any knucklehead can do a trend trade when everything's going your way, buy or sell, pullback. I mean, that's not difficult. It's when am I going to commit to getting the hell out of the trade, and ultimately, what is it going to take to get me back in? Those are the two little components, because some people buy again and then they add on some more down here at the one-to-ones because obviously they got to stop. And then they end up blowing out their whole funded account because they thought it was going to go up. Who was it that sent me that Shogun? Sent me that video. I actually watched most of that Jack Schwager video this morning, which is interesting. I'll post it in here. You guys can go watch it, but check it out. You don't have to do it now, but from this time going forward, he said the biggest thing in trading, when I talk to profitable traders, is I don't get paid for thinking something's going to happen. I get paid for waiting for something to happen. And when you take that concept and you break it down into a trade, right? I'm waiting for something to happen. I'm waiting for fibs to break. I'm waiting for a pullback. And then I'm waiting for the price bars to get above the small triggers. You got to be in, of course. It's our trade. But then you're waiting for management rules. And then once your management rules are true, then you're waiting for closes above your triggers to get back in. Try it again. So it's this, what am I waiting for thought process. Yes, it is being recorded. But do you guys understand that? It's the what am I waiting for process that you have to go through in your brain. And that's why you're not going to be a gazillionaire because you bought next gen last week. It takes time to learn, what's the market doing and what's this pattern? And do I really have to get out or can I cheat? Or can I really get in over here and cheat what he said about the small triggers and price bars? And hopefully this concept of where are the bars in relationship to the small triggers makes you go, aha, that's what I've been screwing up. I'm hoping anyway, because usually most people. So again, look, short signal at the resistance, which is a momentum trade. Remember, I promised you guys we're going to talk about a momentum trade. So, as promised, I'm going to make a couple of arrows here. My brother, he cries to me, and not in a bad way, but he's like, God, these people want to do momentum trades so bad, and they're screwing them up every time. And you guys know who you are. And look, I'm going to solve it for you. You ready? Watch. Are the triggers past the one-to-one right here? Where that red arrow is. If you're looking at the one-to-ones, are the triggers below it? It's not a momentum trade. That's all you need to know. Yeah, maybe you could have sold the fib, but whatever. I'm not talking about the fib. I'm talking about the one-to-one, because a one-to-one could stop the market. right? So we don't want to go short into something that could stop the market. Odds are it's probably going to keep going, but damn it. All right. Now watch this. Very, very, very simple. At the pink arrow, where are the triggers? They are now past everything. That's your secret magic formula right there for doing your trade. Now you can sell the pullback, put your stop where the market shouldn't go above the fib, and then hopefully, you get a down bar and then you can reduce your risk. Now, I have to do this real quick. I'm going to go back to a picture from 1927. I don't even know when the hell I made this picture. I'll tell you when I made it. But so watch. This picture, look at the date. 7/6/2015. Can you guys see the date up there? It might be a little hard to see, but this is over 9 years ago. And nothing has changed, guys. Watch this. You ready? When the triggers cross over, if the price bars are below the triggers, the market has a tendency to continue down. The wider the triggers are and the location of the price bars are below, the more apt the market is to go down. Everybody okay with that concept? And again, this is going to save you on your management. It's going to save you on your momentum trades. It's going to save you on everything that you do. When the body gets on the wrong side of the small triggers, you're not doing momentum trades anymore, guys. So this is from 2015, but look, yes, you can do a momentum trade if your areas are correct and the triggers are below. And then when the price bars are on the wrong side of the triggers, that's a sign of a loss of momentum. So don't do momentum trades. You will lose, guaranteed, most of the time. So again, hopefully this is going to be helpful in some of your thinking when you're thinking about momentum trades or high volume area trades or any trend trades. It's the same thing. This is a 24/6 dynamic Renko bar. I don't know if you can see that up at the top, but why the hell was it a 24/6? I don't know, but it doesn't really matter. The concept is universal. So price bars get above, the triggers cross up, the market goes up a little bit. Usually this is your retracement in a big trend, and then you finish the move. Now, when price bars are below and they cross and they're really wide and the price bars are on the correct side, this is where you get your trend trades, right? If it's a big chart, or momentum trades if it's a little chart. When the price bars are inside or above the small triggers going down, don't do momentum trades. Is everybody? Give me a yes or a no. You get this concept. It's really simple. I mean, I made this 100 years ago, but 10 years ago, 9 years ago. But look, if you get a good bottom and the price bars are completely above your triggers, go ahead and take a shot at it. What's the worst that can happen? You lose a few points. So again, this picture of price bars and triggers is paramount to what you're doing, not only in trading, but again, it's a subtle difference that most new users don't pick up on. Triggers aren't below the one-to-ones. It's 50-50. It's still beautiful because it goes, but you don't know it's going to go. Right? You're stuck at this moment in time trying to make a decision on whether you're going to trade short. So that's what it looks like in real time. And remember, one-to-ones usually will catch an overrun of a fib. So in real time, the triggers are above the one-to-one. And you're like, damn it, I can't go short. And then in real time, the triggers are past everything. You can go short. Now, whenever going back to this picture from 1922, What's the loss of momentum that it said back 10 years ago? I'll just give you a hint. When the price bars get inside and the bars are on the wrong side of your small triggers, it's a loss of momentum. Another sticking point that most people fail on when you're doing momentum trades. You hang on too damn long. So if you're losing momentum, if you make an up bar, you want to get out. So again, when we go back and look at this picture, see how the price bars are below, triggers are below, you get your short, and then where are the price bars relative to the triggers? They're inside, right? That's the first loss of momentum. Once you close above, you're out. So, if you were holding on for the whole home run down to here, right, you don't get it. But if you manage your momentum trade correctly and get in here somewhere and then get out here, you can't lose money. You can, but you shouldn't. And then it sets you up for your trend trade, right? And then you can take a trend trade. And now I want you to don't look at the trend trade. Okay, no worries. I'm going to look at it, Jen. I promise. Here, I'll stop what I'm doing now. We'll take a look at it. Where was your pullback to get in? Or did you just jump? Jump. All right. So, and again, look. Fine, I got it. You jumped. It's a good look for probably going to continue. It would be interesting. What time is that? 9:27. What market is that on? Crude. Bear with me a second. I'm going to make a crude range chart real quick. I just want to see for the sake of seeing. Oops, I accidentally made a 21 range crude oil chart. That's a little big. Bear with me. 8 range. Okay. So 927. Again, look, this is the logic that, if you were to have bought, if you said to yourself, look, the momentum is good enough, I'm going long. Okay, and I think it's a fair statement. This is where if you were to buy one down, you'd be going long over here, somewhere around 34, 33, give or take. You see that? So, again, let's see, where did you go long? You went long at, I can't see that, man. My eyes are not that good anymore. Bear with me. 59, 49. Shit, I can't see. 59. Okay. No, that's not right. I can't see. 39. Okay. 39 was the number where you went long. This would be the difference. Okay. And again, look, you put your stop where it shouldn't go and you made some money. That's fine. But if you were to buy a one down and then trail your stop once you have a one up, you would have bought around 34. You probably would have got 50 cents better. And then ultimately you would have had 50 cents less risk. And then after a one down, one up, you trail your stop to here. And then ultimately, if you lose momentum, right? So, anyway. I don't care if you guys just jump in. It's your money. But there's no plan that we teach that doesn't need at least one bar pullback on a range chart. All right, so I want you guys to focus. Let's everybody agree this is probably a trend trade. Trend trade short. We're going short. Market's going down. When you put in divergence, you have to make a choice. You have to ask yourself the question, what are the small triggers doing? And when I make divergence, which is after the second bar up, what are the triggers doing? Should I still really be risking money? And the small triggers are going to answer your question every single time. Now, they're right about 90% of the time, 80, 90% of the time. And if you look at it, it said, hey, let's try to go short again. And then you get divergence and, forget about rules or anything else. Just tell me one thing. What are the small triggers doing? And where are the price bars when you make divergence? And that's how you use divergence to manage your positions. You look at your small triggers. Everybody got it? Your small triggers will tell you whether that divergence is going to ruin your life or not. Conversely, ask, when you're in the heat of battle and you're saying to yourself, all right, should I get out or should I hang on for dear life? Sometimes you'll get a divergence and even a second divergence. And at the time of the divergence, you're going to ask yourself what the triggers are doing. Small triggers. I mean, obviously large and everything's going down. It's a lot of resistance. But that doesn't matter. You can still lose even if there's a lot of resistance there. So you have to make a decision based on what's happening at the time when you're about to make this divergence. And should you leave your stop up here above the pivot, or should you put your stop right here where a new divergence is going to happen? Those are your two choices, right? Stop behind the pivot or stop where a new divergence is going to happen. And if the small triggers are crossed down, you have a really good shot of hanging on for dear life and making your money. Now, sometimes they'll get you, of course, but usually they just run up, retest the resistance, and then they sell off anyway. Have you guys ever been in a position where you're like, damn it, I got out because of a second divergence, but they win anyway? I don't know if you guys have ever been in that situation, but if you haven't, you will. And the answer is small triggers, small triggers, small triggers. Let's see what else we got here. All right, so anyway, this is not the best example, but I went short on a trend trade and I got out at the high volume area because of what my small triggers were doing. So if you guys are ever in a trend trade and you run into your triggers going the wrong direction, usually that's where the market stops. I think that's the same. Anyway, they're all the same. They're all the same once you put together the thought process. Again, management rules. If you go long, let's say you're doing NASDAQ or whatever. Let's say you wait for an up bar. All right. My brother's going to say, why are you doing this to me? All right, let's look at this picture from two different scenarios, okay? Again, when you guys start reading the market properly, you're not going to trade rules as much anymore as you're going to trade looks. I don't know if you guys have had software long enough. Am I wrong on that? You're going to say the look is, so I'm going long or short. It's not going to be, I need to check rules. That's a great way to start, but you're going to just be able to do what it says to do. And I want you guys to see, again, a lot of times when you get a trend trade, right, like over here might be a trend trade. When the market is so strong below very strong small triggers, sometimes they overrun. And then, if you think about, I'm talking about this spot right here. This is literally the same spot. It's the same fib. It's the same number. There's only one difference. This one has too much momentum going to the downside based on your small triggers. And this is the same exact area, but now you've got your small triggers helping you. You guys see that? This is what we call continuation style, but it's basically if you go long here and you get your ass slaughtered, which you might, which is fine, even if you did it and you took a loser, it's okay. As long as you don't give up on it and you're able to take the second one, you're going to end up feeling pretty good about it. So, again, since this goes with the small trigger lessons I'm giving, and let's say you're like, oh man, I should probably go long, but you didn't do it. Butthole pucker, whatever you want to call it. Okay? It gives you another chance to go long at the mid band with really strong triggers. So again, I think that's the first spot because that was the spot. But you get a second opportunity. And then, ultimately one-to-ones are a really good place to take profits. And again, I just want you to see the difference. If you were going to buy the mid band on a trend trade long and you said, I'm just going to get in at the mid band, that's fine. Now you're fading a lot of heat because of the small triggers. But, that's where sometimes people will wait for a close up if there's too much momentum with the small triggers. Anyway, if you did wait for a bar up or you got in at the mid band, you'd be in at the same damn near spot. The only difference is one of them is closing inside the small triggers, starting to show a little weakening, and one is below the small triggers with no weakening at all. Go back and look at your trend trades that you get your ass handed to you on and do some small trigger line investigative work. Now, anytime you hit one-to-ones, you take some money. What's the rule for a momentum trade, guys? Where do the triggers have to be relative to the one-to-one? What's the rule? It's very simple. They have to be past it, right? Very simple. So when you're asking yourself, damn, should I get out if I get divergence from a one-to-one? The answer lies in the triggers. Where are they? Are they past it? If not, don't get out. You're going to make more money. Probably run up to the red fib. If you get divergence from a one-to-one and the triggers are below it, guess what's going to happen? Almost every time, guys. You guys can go back and look at this as much as you want, but it's the same pattern over and over and over and over and over. And once you get it down, and again, look, there's little discrepancies here and there, So you'll find in my trading plan that I sent to you guys on the NASDAQ, the momentum trade after a good top or bottom in the NASDAQ is awesome. Has a lot of momentum in it. So look, same thing here. If you go short and you hit a fib, we all know the answer to this question, right? I mean, I don't hopefully have to go through that very much. If you hit a fib, ask yourself one question and one question only. Where are the triggers? And it's going to answer whether it's going to hold or break 80% of the time. Not saying it can't break. But in order for you to go short again, the triggers would have to be below the blue fib. What are the chances? 0 with where they're at. You see that? So it's really simple. Where are they at, location-wise, and where are the price bars and how strong are they? Hopefully this is going to help you with some of your management. No, obviously you're going to have to incorporate some of this good stuff, but and the other part of it is you're going to go, that damn Novak with his divergences and scaring me with the triggers. So, again, look, when you go into a pivot stop out, usually most of you guys take half your position, right? So I want you to do some reading here. We had resistance. Everybody agree? We broke resistance, which means we're going to buy support. So we buy support and we go up to a pivot stop out and we're going to take some money. And I can't get this thing to move over enough. But watch, this is a great precursor to what's about to happen. I have to. I like to get to the right edge of the chart because you can't make a decision in history. So everything has to be right edge. So if you're at the right edge of your chart, before you make another divergence, well, first, when you decide whether or not you're going to take some of your money, you have to ask yourself at the pivot stop out, where are my triggers? Do I have a strong trigger line configuration? Is it a weaker trigger line configuration? Are they inside of each other? And then ultimately at the high, are they crossed up or down? And what you may find is after a close back above, you're going to have to get back into a trade or the second half. If you took them all off, you got to get back in again. If you took half off, you might put your half back on. Does that make sense? But do you see how you closed physically above the small triggers? That's really helpful. Can I give you guys one more old picture? Old. So this is from 2004. I want you to see something. Now, this may look ugly to you because it's so old, but 2004, trend trade from the mid-band was our trade. Gee, sound familiar? Look at what the prerequisite was to even think about going long or short, to initiate a trade setup. It wasn't sell the mid-band and hope. It was wait for a close below the triggers. Now, with dynamic Renko bars, obviously this is a little bit different, right? I think everybody can agree dynamic Renko bars change this. You got to sell at the area sometimes. But this concept of being on the correct side of the triggers has been universal from the beginning. And when you get to fibs, if they don't break it, we only used to have a small trigger. We never had a large trigger back then. So we've done a lot of work with just the small trigger, and once you start doing it, you'll start to see things that pop up, like support's not going to break. Closing above the small trigger is another way to get back in. All right, let me get back to where I was. And again, look, obviously, when you're looking at going short, from resistance, right? So, again, if you're going to go short from resistance, you're going to ask yourself the same questions. Where are my triggers, and are they above or below the resistance? And if they're above the resistance, you're probably not going short. It will eventually put in a bottom and keep going up. It's a very, very, very specific look to go the other way. Again, look, this is an example of trend trade. Pretty easy, I think. Trend trade short. You get divergence, pivot stop out. So let's say you get out of half your position. Fair assessment. You're short. You make $150. Take half. Now, remember what I said about closing below your triggers. Again, you pulled back to your trend trade spot, but you never closed below your triggers. Now, I guess you did over here, but they're really going up strong. So, if you were short again for some reason, then this small trigger line look really, really, really will end the trend. Check this out. You see this mid-band? That's a momentum short from the mid-band. Now, we have to go on the assumption that we had a super good top, right? And lots of Fibonacci resistance and all that good stuff. But I promise you guys I would fix your momentum trades. Where are the triggers and the price bars? Can you do a momentum trade short? Now, it depends on the high, of course, and terminations and everything, but that's all there is to it. Sell a pullback after a down bar. Now, when does it lose momentum? It loses momentum over here. Helping a lot with, well, we'll see. It's going to be a effing train wreck for a few days because everybody's going to be trying them everywhere. So, let me go back to the rules for a trend trade or any other trade. Okay. I want to have terminology. Okay. You have to have a good top or bottom with momentum. You have to have weak triggers on your big chart. You have to have big super termination conditions. What the hell does that mean? Super termination conditions. It means that you have termination conditions on all charts. I don't think I have an exact picture. Let me see. Let's see. I'm just trying to look. Yeah, it's not a great picture for it. Anyway, long story short, momentum trades are all going to be the same thing. Strong, 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 strong. Triggers on the right side. So, again, look, this is the S&P. And let's take a peek here. It doesn't start out termination condition, but it ends up that way. So remember we talked about divergence from one-to-ones being potentially termination condition. So again, look, we had divergence from one-to-ones, and I'll let you answer the question. This is the real S&P now, live. From the top, at what point did we, we can do it from the bottom too. Let's do it from the bottom with divergence. At what point do we have the correct trigger lines to do a trade? So, again, if you're going to cheat a little bit, and I know every one of you are, because unless you're a liar, you're going to try to cheat the system a little bit and do some extra trades. At what point is the first spot visually where you have a support that potentially has the right trigger line look? Now, we do have a little resistance there, obviously, so you'd have to trade into resistance. Yeah, so strong triggers going up with price bars above them. Now, probably wouldn't do that one into resistance because real time, it's easy to see after the fact, which is total bullshit. That's why you sit there and go, man, it's going without me. It's not that it went without you. It's you don't have a trade set up. That makes sense. Now, when it goes anyway, again, this is a lot of what happens on the small chart is whether or not you do a trade here or not. Same thing here. You're not going short into a mid-band and a fib. It's just not going to happen. It's not yours. Right? So don't lie to yourself and go, oh, I missed it. Now, termination at the bottom. Now, this one's a little bit different because we have weak triggers with the termination. We have very strong triggers going up. This is probably a decent opportunity to take your first shot. And then I would guess that this is probably where most of you guys took along to get up to resistance. And now we're in the muck because look, how many triggers are below this fib support? 0. So it's termination. That's it. Now, does that mean it won't break? No, of course not. It could break. Sure, it could break. But we'd have to wait for it to break before we start doing anything. So let's hurry up and wait. So look, let's just say hypothetically where I drew the circles, you're going to end up thinking about a trade setup. So this is the first circle long. It's all right. It's not bad. You got every trigger in your midband on the planet. And then as we start to really get above fibs with all of our triggers, this is about the bar right here where you're like, yay, it's going to go. And then if you were holding on for dear life, you know, we talk about one-to-ones on the big chart being terminations, but you can also see terminations on their small chart. So multiple divergences, 3 divergences. Ultimately, it ends up being a top, right? And again, if you went long, you weren't going to be able to hold through that. If you went long, it was okay. You're just not going to be able to hold through it. And then this is the one I said you'd probably never go short into support. So I want you guys to answer the question and be realistic with this, because it's easy to see in retrospect, but it's don't bullshit yourself. How many triggers are past that fib? Would you really sell it? No. You might, but it's not your trade. It works. It goes down. Now, is there a different Fibonacci that we break fibs and the triggers are going down? Now, this is where you would put your trade on, hopefully. You see where the triggers are? That's your trade. I bet you $50 it's a 1 up, 1 down on the 8 range chart too. I would bet money on it almost. So look, here's an 8 range chart. So this is the place where we said you'd probably never do it. Now, that's not a bad trigger for it. And then this is the place where we said you would do it. Again, still good triggers for it. Good triggers on both of them. But this one is your trade right here. Resistance, all triggers. Doesn't matter what the rules are. The triggers are right. The rules are right. The area is right. And room to your target's right. That make sense? I don't know what rules you want to call it. I call it everything says it should go, so that's your spot. Now, let's talk about trend trade shorts. Right? So if you do a trend trade short, which I'm all for, you're going to have to assess at your pivot stop outs what your triggers are doing. Where are, price bars are below your small triggers, that's fine. So let's say you took half. And then you get a new pivot, so you trail your stop, right? And then you'd be watching over here. What's the one thing you notice about that right there? Your small triggers are between both of your others. They're above your small, above your large. Third divergence. You start to recognize, oh, wait a minute, that's 3 divergences in a relatively tight spot. They're going to go run the highs, which they do. And then if you were to go long, which I'm okay with, right? Look at before they make this divergence. What are the triggers doing? Because the divergence doesn't happen until after a couple bars, right? So when you're in a long trade and you have a small trigger crossing, answer another question for me. Where are the price bars? Let's see. I didn't spell that right, but Need my Grammarly. Again, it's one of those, you probably are going to take it, but you're going to manage it a little bit quicker. Now, at what point can you go again? Now, I've made a big stink out of this, right? So you have to have a close above your triggers, usually, to try it again. So, again, you can try it down here, of course, but once everything rolls up again and you've got a second chance, obviously we take it up to resistance. Now, resistance in 1-to-1s, I don't even need a big chart to tell me. You can see it on the small chart. How many triggers are past that? If you're thinking about hanging on for a bigger number, more money, or whatever else from your long trade, how many triggers are past it? 0. That's all there is to it. Now, let me ask you a question. If that's a good top and we're hauling balls to the downside and you're trying to make a decision on whether you're going to do a momentum trade, what's going to be the number one driving factor for you? Again, this one's probably not the best momentum trade. And again, it goes down. You could call it a trend trade or whatever, but it's not a momentum trade. All right, cold beer for whoever answers why it's not going to be a momentum trade. Cold beer is for everybody. I'll go back to 10 years ago. The price bars, location. The body of the bar has to be below the trigger. The body of the bar has to be below. If it's inside, we're losing momentum. So it means they'll pull back a little more. It doesn't mean that they won't change trend. It just means they're going to pull back a little bit more than you think they're going to pull back. They'll make a trend trade. So again, when you look at this, again, it's very easy to get excited and go, holy crap, it's going to go. It's not really, it's an okay look. But the real look that we want to see is the price bar is physically below the triggers. Now, as far as trend trade goes, it works fine. Let's see what we got going on down here. So we made it pretty damn close to the fibs. Agreed? And this is the point in your short trade. If you have a short trade, you have to ask yourself a question. How much do I have to risk in order to get that last few points to the fib support? Do you understand what I'm saying? So 875 was a low, and the fib is 2 points lower. So how much do you have to risk in order to stay in to make 2 more points? Sometimes it's not worth it. Usually what they will do is they'll come up to the edge of the synthetic triggers and then they'll finish the move off. And then that'll be it. All right, Samuel. The auto app answered your question. Tell me if it doesn't make sense to you. But it's 100% Fibonacci projection. Do you do any fib work? Have you ever done fib work? So, short version, are you ready for this? Samuel, I'll give you a visual. If you were to take the high and then the distance to the low and then add that distance to whatever the retracement was, 100% of that range would give you 100% Fibonacci projection. Does that make sense? So this is just a different visual. The one that's in The auto answer is just as good, but it's the same thing. You're taking the distance from A to B, adding it to C, which gives you the 1-to-1. And then distance from A to B, add it to C once you have a C, and then 1-to-1. Okay, cool. So again, look, we may probably make it down here to fibs, but at some point, look, if you were short from resistance at 08 and you took some money down here at 98, 99, and you took 8 points on the S&P and you're up $400, that's a whole day's worth, isn't it? Now, the beautiful thing about it is the triggers all agreed. What was in your way? What was physically in your way between where you wanted to get short and the money pit? Nothing. Nothing is in the way. That's ideal for what we're doing. So when you add to it, what was happening on the large chart? We came off resistance. We were below on all triggers, on all charts. We had room to go. And then ultimately, like I said, this is probably where they're going to test, and then they'll make their decisions right here, whether they're going to keep going up or not. I hope they don't go up from here, because they didn't finish the move totally, which, look, if they would have hit fibs, it makes it a hell of a lot easier to go long. When they don't quite reach them, usually they'll sprawl back up and will hit resistance, and then, that could conceivably be a nice termination spot for us. If we get to this resistance, somebody answer the question for me. Before we get there, how many triggers are going to be past that? Either the mid band or the fib. How many triggers will be past it when we get there? None. I can tell you in advance. None. So no matter what you think, it's going to be a termination area. Which means they have a lot of work to do before you get easy longs. You really need to come down here and make a termination at fibs, and that would be a better one. Hopefully that's pretty easy to see. So right now, these are the two areas where the market should trade in between, because both of these areas have zero chance of the trigger lines breaking those areas. So we should make it up to resistance because of what the triggers look like. And then stop, drop, and roll or break out. I don't know what's going to happen, but we don't have to know. We just have to have a plan. Could make a little pivot stop out there. So again, we'll see. Usually this is where they end up holding this resistance if the trigger lines roll over, and then we make it down to here. We'll see. It's close, yes. Technically, yes. But here's the problem with this trade. Is it the last possible area guaranteed for sure? Or is there another line up here? And where are we closing in relationship to our triggers? So yeah, it may be something to the downside, but we haven't even closed below a trigger yet. So now we've reached the last line, which makes me a little bit more of the thought that if we're going to go back down and test that would be the first spot. Now, if you go short with small triggers past your last line, so you guys tell me, are the small triggers past that last line? Yeah. So it might be a termination where you're not going long, but I would be hard pressed to think you're going short. Now, that could change in a minute or two. Right now, there's no longs, there's no shorts. If life is good, they're going to come down here and test 97. There's no reason to think shorts at all for any reason. You see how simple this is, though, Paul? See how the triggers are still up and above everything? It doesn't scream go short. It screams we'll probably get a breakout to the upside, but still have to wait for it. We'll see. Doesn't Mark say that they're going to battle at Fibonacci areas? Now we're battling. They're battling. We're not battling. We're waiting. We want to pick the winner. Right? There's two people in a fist fight, and we're going to let them duke it out until one of them's almost winning for sure, and then we're going to take that person. That's our bet. Right? That's what we get to do, really, truly, Morgan, is we get to bet after the fight's over. Now, we don't always have somebody take the other side of our bets. But that's really all we're trying to do is, again, I've got so many old pictures, you could pull them out, but this is the short version of what we're trying to do. We're waiting for a top to be put in place. We're waiting for the triggers to roll. We're looking for momentums or HVA trades from the top. When everything is super strong, we'll do trend trades and then vice versa. I mean, this is the whole trading plan right here, guys. If you learn to read your triggers properly, you'll do the right trade 7 out of 10 times. I have crude. Here it is. I guess they have pretty much, look, we were talking earlier when we got started in the room that we were going up. Right? So I drew in some boxes and some lines and some pictures and said we'd probably go up. So it's not really a mystical, magical thing. We're going up. And look, we went up and we got within. I know everybody wants our fibs to be perfect every single time, but after you put in divergence with weak triggers, we're probably going to make it to the mid band, and then they'll make decisions right here. And again, as we start to get to the mid band, at what point do we have enough momentum and small triggers below the mid band to warrant going short? Right, so that's pretty close right there. Nothing changed. So, longs with everything going up. Shorts if you get them with everything going down. Pete, you caught the short. Cool. Somebody else posted a trade a minute ago. I don't want to not look at your trades, so bear with me. All right. Trading book, this is yours. Yes, good top for sure. And absolutely. So this is gold, but it's kind of the same look we were having from crude oil, right? All your triggers are down and below all of your lines. So that's a perfect look for going short. Would you agree? And then trend trade short, and you're going to get divergence. It's going to take you out. I can see it coming. Okay. You see how the divergence is coming right here on this picture and the small triggers are up? So if it happens above, the reversal bar marker, it's probably going to take you out. I know you have more pictures, so I'm going to keep looking. Bear with me. So your next picture is basically the same. This is that same spot. And they made a run for it, but our small triggers were down. Oh, no. I see. They went all the way back up again, didn't they? So we missed part of that. So, trading book, tell me, from here, they went all the way back up to the high again almost, huh? With this divergence, with the small triggers up. I'm just trying to catch up. I don't have a gold chart open, so this little one bar right here, you had the right trade, everything's perfect. Hopefully the management was perfect. Small triggers up, a divergence, get the hell out because they're going to go higher. You have to respect this pattern. You don't have to, but to your own peril if you don't. All right, now let's take a look at your next one. I like the chronological order. So this is the ES, and no momentum entry, and yes momentum entry. That's exactly correct. 100% perfect. A good top, divergence on all charts. Did you guys know that if you have divergence on all of your charts, it's the same as a termination? Just saying. But yeah, this is exactly, if you're going to do a momentum trade, that's the one. And do you see the other part of this trading book right here? You're going to get divergence, but you have to ask yourself, am I going to get out because of it? Which is the part that scares the living shit out of everybody with momentum trades. Tell me if I'm wrong here, but I think this scares everybody with momentum trades. If you get a divergence, it's like, oh my God, I got to get out. So you're just getting in when the divergence happens. What you have to ask yourself is, what are the chances of divergence causing anything bad to happen with the look of the triggers? Well, you just deal with one divergence at a time. So before this divergence plots, you have to say, what are my triggers doing? And am I going to, I didn't finish my PDF. I know I got kind of sidetracked on doing pictures, but that's exactly the momentum trade you want to do. 100%. Without question. Perfect. Let me go back and finish my PDF real quick. I know I'm kind of... Alright, so look, there was one more picture that I did not finish. Reminder on divergence. Small triggers that are trending higher or lower. So we're going to kind of round out this whole divergence talk. If they're crossed down, it's probably going to keep going down. Not only are they crossed down, but do you see how the small triggers make lower lows than the small triggers before? And the small triggers make lower lows than the small triggers before? And the small triggers make lower lows than the small triggers before? That's another indication that divergence isn't going to stop the market. It can, but it usually doesn't. So not only do we use are they crossed up or down, but also are they trending higher or lower? So one more little teeny tiny thing to peek at. Since the dawn of man and trading, higher highs and higher lows, I mean, that's pretty much universal. Here's the question, though. Do you want to get out because of a divergence? Is really the big question, Rob. You have to make up your mind before the divergence. You know how we have the divergence potential plotting, and you're like, oh shit, might be a divergence. You know, the little number that's floating. So you have to make up your mind whether you're going to get out with divergence before it happens. So you can put your stop in the right spot. So you have two choices. You leave your stop behind the prior pivot, or you put your stop where a new divergence is. It's two choices. Anyway, I think that covers most of what I wanted to do on that PDF. If you guys are doing range charts and you want to build a range chart, don't put the market flow on it. Learn to read the triggers first, because all these dots don't really mean much. There's very few times we go, oh, look, there's some dots, we're going to do something. It's very, very, very rare. All right, so let's catch up. They drill, baby, drill, right? All right, so they are selling off crude oil 9 ways to Sunday. My gas prices aren't going down. You know, I left my little bubble. You know, we live kind of in a tourist spot, Siesta Key in Florida. And man, I filled up my car, and then I went like to the other side of town in my other car, and I filled up, and it's 40 cents cheaper a gallon for super unleaded. I was like, man, we're getting robbed over there in the tourist trap. Anyway, that's a whole other point. But gas doesn't go down that much. 40 cents on super unleaded. Anyway, if we're going to do a trade from this spot, obviously it's a pretty good look. And you know, this is, whenever you say, oh crap, they're never coming back for me, that's kind of the look. I mean, there's one chance, but then any other chance you get is going to be on a very small chart. All right. So this is live. You know, crude oil, I don't watch crude oil all the time, but you see how we got through the one-to-ones right there? And the triggers are past. I know the one-to-ones aren't very big on this template. I can make them bigger, but once the triggers got past the one-to-ones, the chances are we're probably going to finish off the move. We've got a weakened trigger line condition, so all it's going to take to ruin the momentum is one bar up. You guys got that right. If they never make a bar up, then they'll get to the fib. If they make one up, momentum's probably over. We're out in the middle of space right now. Hopefully they just go down to the blue line and stop magically. No, Samuel, that's not the case. The one-to-ones come from different swings. So, how can I explain this? Just put it this way. The yellow ones come from big trend-changing swings, and the smaller ones... Hang on. When I was doing the one-to-ones in TradingView, I found an indicator that really did a good job, because I was explaining it to programmers. And let me... just show you something. Bear with me 2 seconds. Okay. Can you see this? So this little indicator. So do you see these little swings that are in purple lines? That's where the little magenta one-to-ones come from each little swing in the market. When we look at yellow one-to-ones, they come from what would be the cyan lines. So they come from the big swings in the market. So, when we look at Fibonacci projections, which is what it is. So you take a projection from there to there and pull it down to here, and this is where your yellow one-to-one would be, way up here, if that makes sense. And then now that we're looking at downside, at least the way it started, it changes as it goes, but you'd start here and pull it down to here and then up to here, and then your one-to-one is way down here. And then if trend changes in between, then it redoes or redraws the one-to-one. So you'd end up doing another one-to-one from here to here to here and projecting out. Anyway, just a visual. I should want to say those changes. So again, when you have all the other indicators on there, it gets a little dizzying. But basically, it's just small swings. You get magenta one-to-ones. And then the big swings and big trend changes create larger one-to-ones. All right, so they did what they were supposed to do. So look, when did I draw this box in? Quite a while ago. So it went exactly to where it was supposed to go. Let's see if there was any opportunities to go short that make sense. There is not a lot of opportunity in this one. So remember what we had talked about was triggers are past the fibs, we're probably going up. That's what we were talking about over here. And it was true, and they went up a little bit, but the triggers didn't really get back down below the fibs until here. So the first conceivable trade probably would have been a momentum trade or some type of trade right there. After that top actually held, more aggressive traders may try something there, but depending on the market flow. But realistically, the easy one for you guys is when we got this. And what you'd be doing is saying, please pull back to right there. After we break through, let's pull back, and then I can get the rest of it, and it doesn't happen. Now, can I show you guys something without freaking you out? It's going to be called, I know it's going to shock the crap out of you guys, but it's going to be called the trading guide. And in the trading guide, it has additional trend trade techniques. And it's all the same stuff. There's nothing different. So everything that you have had and seen is the exact same as it is now. But there is, when you get to a fib and you say to yourself, this fib may hold, there's one type of trade that some people will try. It's called a continuation trade. And it's just top or bottom, pull back to the small triggers and go. But you have to have a very reasonable expectation that that area is going to hold based on where your triggers are located. So again, there is opportunities from areas, and using the small chart triggers really do help. This wasn't one of them. And the reason why is because, at the time you would have sold a pullback to your small triggers, all your other triggers are past the fib, which makes it a bad idea. Now, it worked, but it's not very good. Perhaps one trend trade from here, if you were to do it, and very, very little opportunity for making a bunch of money. But I guess 4 points on the S&P is still $200, isn't it? And then look, we'll go long if our small triggers get above all of our other triggers. Did they? No. So it's a beautiful Fibonacci area. Maybe it's easier to see over here. It's a beautiful Fibonacci area, which if you had a short, which I don't think we did, but then we have a little bit of a target. But we have to ask ourselves, where are the triggers and what are they doing when we get here? Well, they're pretty darn strong. So they're not really thinking of long trades. And then we get to these one-to-ones. And a lot of times the overrun of a fib area is contained by the one-to-ones. So conceivably, we have to break below 92 to get our next short trade. Or at least to pull back into here to take a shot. I don't know what's going to happen. It looks like we're going to go down a little further. 92 is kind of our line in the sand. So we've got 97.75 line in the sand up here. Which, again, look, this is going to be our make or break spot right there. I'm not a fan of going short after divergence from a one-to-one. You can do it, but it makes a trade about 50-50 instead of 80-20. And this is the spot to go short if you were going to go short, for sure. I want you to notice something. So let's just say you go short here, okay? So let's say you're short. I'm going to do it anyway. You go short. And I want you to notice something. If we make a pivot stop out of the low on the little chart for your short, look what you're going to run into on the big chart. You're going to run into that other one-to-one. So if you do take a trend trade short, which I'm okay with, it's an okay trade, the pivot stop out of the bottom is also going to be into a termination condition on the big chart. So that's why I said 92 is probably the line in the sand. It's not only the line in the sand, it would be your target too. And they would have to break 92 convincingly with triggers to keep going, which they can do. Now, watch this quickly. Before anything happens, tell me right now, would you get out with divergence against the short? So watch this. So right now, let's say you were short and you had to stop above the pivot. So this is where you guys are going to, in the real world, have to make your decision. Am I going to get out with divergence or not? Right, Morgan? Thank you. You can see it's just wrong. But I wanted to freeze it before it actually happened so you can see it live. I mean, I think live is such a better teacher than, history, you got to go through concepts. That's fine. But in the real world, when you see it, you're like, holy shit. Price bars are above the small triggers going up, and I have divergence potential. And divergence from one-to-ones, which is not one of my favorites. Usually it makes this a loser. So anyway, there's a whole story being told here. Yes, it's down. Yes, it's a trade. There's divergence from one-to-ones, which makes me go 50-50. If you take it, and then you're faced with this situation, this is where people take $100 and they get to break even, and whatever happens, happens. Probably is going up, but let's get back to it. All right, it bounced up from there. And again, look, if you were in, you don't lose any money. I'll still say 92 is going to be a good line in the sand. Now, here's the other part. If we go all the way down to the next fib, what is it? 84? There's plenty of room in there for you to make some money. So right now, how many triggers are past all these 1-to-1s? Nothing at the moment. So if you're thinking, oh, I'm about to do a momentum trade short, probably not. Would be my guess. Now, we could easily go down and keep going down. I don't know what's going to happen. I don't have to know. Hi, let me look at some picks. There's 92. Line in the sand. It's come down so far already. Do you look at the expected moves on the daily? No. All you need is these two charts, if that's what you're trading. There's nothing on a daily chart that's going to make you smarter about 92. So can we agree we had 92 as a yellow 1-to-1? And at the moment, none of the triggers are going past it. So it doesn't matter what happens on a daily chart or another chart or a bigger chart. Now, they may break it. They've got some momentum behind them. That's fine. But for us, we want to see them break 92. And then we'll take more trades again. And if you went short and got out and said, oh, that damn Novak and his rules. Look, 20% of the time they'll keep going. 80% of the time they're going to take out the high. So would you rather trade with the 20% or would you rather trade with the 80%? That's the choice you have to make. I think it's better personally because there's more money to be made at a top or bottom. From a top or bottom. The idea, though, that you have to have every chart terminate before you really try it is super important. See if I have a picture of that. Huh. That is so weird. Oh. It looks like they want to get through it. We'll see. Now, in the real world, would you guys say that we have now gotten our triggers below this trouble? I mean, look, a perfect trend trade is a great trade. There's nothing wrong with a perfect trend trade. Ooh, took off. Nothing wrong with a perfect trend trade. You know, but let me go back to 2004. The first money that you're going to make, you know, and again, look, this was our rule from our trading plan in 2004, so don't laugh. But it was very simple. We had bearish divergence at resistance. Once the triggers rolled over and we pulled back to them, go short. Which is the same thing we teach you today, which is wait for multiple charts to agree at a top. And when multiple charts agree to a top, then you can be quicker to enter at a top or bottom. We only had one chart back then, and one trigger. So it's very simple. You'll find trading gets a lot easier when you only have one chart and one trigger. It either is or it isn't. There's not as much thinking to do. All right. Now, do you guys remember we talked about the whole one up, one down thing? It's going, and oh my God, I'm never going to get it. So, this is a kind of an example of that one up. Go short and hope they make it to the next fib. You guys see the look? Triggers are screaming. We're outside the outer band. I mean, that's just basically one and done, too. So if it gets stopped out, it doesn't go. So if you sell a one up, your stop goes above the one down. And you don't move your stop again until you get another one down. Like right now, that would be your stop if it goes down a bar, assuming it will with the strength. So you'd almost be at break even right now, conceivably. Did you guys get that? That wasn't too quick, was it? We had talked about what if it's just going without me and I can never find a way to get in. That's where this little one up, one down trick works pretty well. It works better on the NASDAQ than it does the S&P. And you can see we ran into a little trouble. So watch this. Answer the question before it happens. Is this divergence going to end the trend, or is it just going to give us a better spot to sell? That's what we have to answer when we look at divergence. So we broke 92. I'm going to give you a guess as to where the probable entry point would be. Somewhere between 92 and 92.75, and it shouldn't go much above it, or else it's going to keep going. I don't see that at all. Now, if 92.75 gets taken out, I may change my mind, but for now, it looks to me like all the triggers are below the one-to-ones, so they could be a termination. Would you guys agree with that? Location of my triggers is, they're weak, but they're way below the one-to-ones. So it's not a perfect momentum trade, but one more shot at a trend trade is going to be okay as long as there's room to a target, which we have a ton of room to a target. So the 92 was our termination. 92 is probably the short. 84 is your target, target 1. 82 is your target 2. Or a condition that says it's not going to go. So if you were short, watch. Live like we did with trading books. So look, live right now, you have to make a choice on where your stop's going to be. Now, we want it to go all the way down. So, but if the triggers make another divergence, your stop would end up being here instead of up here. Does that make sense? So if the small triggers stay up and you get a divergence, you'd probably get out. But if you were short from the right spot, it'd be okay. And if we get another divergence, so look at the triggers and then count the divergences. So we've got 1, 2, 3. Small triggers are up. Now it's probably over short term. Sam? Rob, you see that? Now it's probably over short term. Now, if it closes back down below, we'll end up getting to the fib. So, but you don't know if it's going to go from here, or if it's going to go from here, or if it's not going to go at all, or it's going to go all the way up to resistance up here. You don't have to know what's going to happen. All we have to know is that if you took that last one, can you guys see it okay? I mean, is it visually pretty easy? Yeah. Small triggers are up. Downtrend is screwed for the moment. Usually when it's over, they go retest resistance. So we'll probably go up to 97. Maybe. I mean, they could stop here and go down. But if they do, then you have to do another one. But if they don't, save ourselves some money. We want them to go down to the blue fibs. But sometimes they're a little reluctant and they have to, they have, I call it getting a bigger running head start. And this is what the look is traditionally if they have to go get a running head start. So if they get weak and you make divergence and then it goes all the way back to the fib in the midband, so again, you can kind of see that pattern playing out. There's a close below your triggers. If you were super inclined, that would be your one more shot at it. It's not the best trade, but it's the last chance if it's going down. Do you see it? How we allow the close below the small triggers to kind of happen? And then another divergence that really ruined the party. So you'd hope that they would not have another divergence at all. And that they would actually reach the target before divergence again. We've already had 3 divergences, so they're telling us something. To me, I mean, usually they make a bigger running head start, so I wouldn't be surprised, but sometimes in a strong trend, you got to sell again. So right there is our line in the sand. It should go down right now if it's going to go. Literally right now. If it's going. Do you guys understand why I say that? Small triggers have rolled over. If we make another divergence, it's just not going to go. And then they're going to end up running all the way up to these fibs. So like, even if you took a last chance, you lost a little bit. Again, do you want to do that after 3 divergences? Maybe you do, maybe you don't. I'm okay with it. I don't care about a small loser. It doesn't bother me a bit. I don't know about you guys, but it's the big losers that irk me. So look, we got warned. We got warned right here that it might go back up, and then they ended up going down anyway. And then we got warned right here that they might go up. And then, they bounced a little bit, but then they said it again. They said, seriously, we're not going. Now, just read your trigger lines here. Does that look like time to go short? Or in the short term, would you think that it would be more likely we go up to resistance with this trigger line look? Now, I'm not advocating counter trend trades against, the wrong look on the big chart. It's a good way to lose a bunch of money. But my guess is that this look is going to propel us up to resistance. It may not. If we had started from fib support, that would be a look where I would take a long. Do you see what I'm saying about this? Did we start this low from a really good spot? If the answer is no, then you can't cheat on the little chart. You have to wait for the little chart to roll back to the sell side. Yeah, but that's on the small chart. The big chart drives the bus. So does this thing say we made a good bottom, or does it say we did it from fibs or divergences or anything else other than down? So they overran a little bit, which is what they do. Whenever there's a bad divergence against you, this is what they do. They go stop everybody out, ruin everybody's day, and then eventually everything will either line back up for another short trade or we'll go reach the fib. I'm not sure which, but looking at the big chart, I'm guessing down, but smaller charts don't agree very easily. D. All right, Kenny. You know, I pulled this workspace up. I haven't run it in God knows how long, so disclaimer. I'm still going with my chart. Whatever my chart says. But I wanted to show you guys just small triggers by themselves. So these are the small triggers. I drew the large triggers as the small triggers, but see what we were battling against on just the small triggers? Just a battle. All right, now let me ask you a question. If you still think we're going down to the fibs, which I think we are, what if you got divergence with the small triggers crossed down? I'm not saying it's going to happen, but what if? Might be different. My guess is we're going up to here to get a running head start. Still just a guess, but usually that's what they do after weak triggers and 3 divergences. They go retest fibs. Oh, hang on, I'm trying to put my template back on the way it was. 5-1. There we go. So line in the sand. What's it going to be, guys? 98, give or take? I drew a box, so it's not like you have to guess. Come on. There we go. Okay, good. Now watch. Here's something that normally will happen. Usually if you have divergence and weak triggers, you're going to make it to the mid-band over here. Fibs and mid-band. So because there's divergence and because there's small triggers rolling up, you may see the 92 one more time bounce. Yeah, I don't know if it's going to go down that far, but if it comes back down to that 92, it may very well bounce for 4 or 5 points. But do you see how the large chart triggers finally agree with it, this is what I was talking about earlier. So we have 92 as kind of a number. We've got small triggers up, and we have an expectation that we're going to make it up to 97 and 98. So again, this is maybe, but it's not from the one-to-one. This is where people do momentum trades and screw the pooch. See the one-to-one? Not saying it can't go up from there, because it certainly can. But it's not a trade because the triggers aren't above it. Which means that if there was a trade, it would have to be from a lower area. Does that make sense? It can't be from the one-to-ones because the triggers aren't past it. All right. I'm going to bore the crap out of you guys for 2 seconds. So we had 3 trades in 2004. Our top 3 trades. You ready? Hit fibs with divergence, triggers roll, try to get a short. Everybody okay with that one? The other trade that we had back in 2004, which we already talked about, was a trend trade, which was pull back to the mid-band, close below the triggers, get out at the fib. Another trade that we had in 2004, which I know is going to shock the crap out of anybody, but was a momentum trade. It was trade number 7. But when the triggers got below, see, this is actually wrong based on the way I teach it now. Triggers were above, not so good. Triggers below, now it's better. Anyway, we're a little better than we were in 2004. But it's the same damn trades. 20 years later, guys. Oh, there was our pullback. We hit fibs, though, so. Anyway, look, we had divergence, yes? And again, we have to have an expectation for what that divergence is going to do for us. It should give you one more bounce up because of what the triggers are doing. The size of the swing used to calculate them. Different swinging levels. Big swings versus small swings. So look, even though we had divergence from a fib with these triggers, I'm expecting us to go and stop out the high maybe one more time. We'll see. I wouldn't go long after hitting resistance. Again, right? I mean, that falls into the termination category. Hit resistance. How many triggers are above it? 0. So, long trades are not going to be good. Like I said, they probably needed to get a better running head start to go finish this business down here. Does that make sense? So at some point, the momentum dies out on the small chart. Takes us back up to the big areas, and then we go finish a move. So let's see what we got. Okay, it's on the wrong side of the large triggers, but can you see it? So there's a but to this one, but can you see it on your small chart? We're moving into where a momentum short probably is going to be a good idea, if it even happens. Rude. Sometimes they go without giving us chances. That's why the NASDAQ is a little more fun for people that have their plans down. I mean, there's nothing wrong with the S&P and crude oil, of course. Let's see if we ever made it to the fib. Sure enough. Look at that. Huh. So remember we were talking about momentum short and that we should make it to the fib. That was about it. And now they're doing battle. They overran a little bit. Now the triggers are above. The triggers are still not below yet. So they're battling it out. I'm not sure exactly what you're asking me. You talking about divergence lines that stick out to the right? Okay, perfect. That's easier. Anyway, this is what they call finishing the business. They run back up to get a higher starting spot, then they run down to go finish the business. Not an easy trade in there at all. It did exactly what it said it was going to do, at least from a chart reading standpoint. Just not an easy way to sell it. Kind of sucks, doesn't it? Sometimes they give it to you, and sometimes they don't. All right. Let's take a look at what happened on a range chart. See if there's anything. I mean, we knew they were going down with pretty high certainty. We only had one possible one up, one down right there. I mean, there's no other way to get in. So there's just not much to do, unfortunately. All right, let me take a look. Okay, no, you've overread that one. Explanation time. So, bear with me here. Let's see. I have a template. Fibonacci lines only. Okay, so oops, let me do this. Okay, so these big fat 1-to-1, or the big fat red lines right here, those are 21.3 fibs. So it's the 21.3 fibs superimposed on the smaller chart. Are you okay with that? So it was blue and then it turned red, and that's what happened. So when we run on our smaller chart, again, technical explanation. When we run the synthetic fibs pro trader, we're only plotting the most current, meaning one above, one below support and resistance. We're not plotting all of them. So when we have just the pro trader on the chart by itself, it'll plot all the fibs from that time frame on the chart itself. When we synthetically plot these fibs on a different chart, we will only plot the closest two. So we're going to plot this one as resistance, and then this should be where the big fat support is. If this one breaks and becomes support, then the only two plots you'll see are that and that. So if this breaks back above, right? So And what we do on these synthetic fibs is if the triggers are crossed down and get past them, we'll turn them red. So they turn red a little faster than the original chart, which was useful for us when we're doing trades. So again, synthetic fibs, let me just find a small choppy one. So look, this was a resistance from another time frame, whatever it was, 5-1 or whatever. The minute that the support from the 5-1 broke and became resistance, this one stops plotting. Because technically it's a long red line on the 5-1 chart, but we don't need to plot it on the other chart because we've broken support and we're only just going to plot the next support, and one support, one resistance. And you see how this one kind of breaks because the small triggers are above it, and it starts plotting the next resistance, but then the minute they cross back down, it's like, oh, nope, that's resistance, that's support. So it's the same line. It's just when are we going to plot it? So we're only plotting one of each on the synthetics. So technically it's a long line on the other chart. You can see how it goes all the way through. So anyway, a technical explanation of how the software works. Did that answer your question? I want to make sure it did. So there's no significance to it being long or short is the answer to your question. Okay. Now you guys see the low. This is what we call kick-ass low time. So we have divergence, no triggers passed, everything's rolled up. This is what we're looking for when we're looking for a good low. The edge of support to hold with divergence. Probably going to bounce down a little bit, but we should have short-term at least made a bottom. They're not small, they're from another time frame. It depends on what your triggers are telling you about that line. So, like right now, the line we're concerned with is this line. It doesn't matter about anything else. Is the mid-band going to break? Probably not. So it's probably going to pull us back to here, which is probably where you should have long trades. Right? I would guess we're going to be doing some type of long trade from over here. Maybe even just from the mid-band. We'll see. They might not make it much past the mid-band here. We have a strong bottom. That's a good bottom for sure. How do we calculate a strong bottom? Well, divergence from fibs with both triggers rolling up strong, that's a good bottom. That's all it takes. Now, for what it's worth, if you have questions about that, this video that's on this first 30 days to being consistent, this is a really, really good video. It's a little older, but it's an oldie but a goodie. Trading the edges, tops and bottoms, and it's about not just trend trades, but also defining what is a good top or a good bottom. And, again, a good top or a good bottom, is either a breakout with wide triggers, which we had here, or, that's not bad for a top, but it's not really an easier one until it gets over here. And then we got a good bottom, no triggers passed, divergence. That's why you guys pay us for software, so you know where that line is. I mean, can you imagine the poor people that didn't have any clue where that line was? Still trying to go short? Anyway. Man, you guys are going to ask that question 9 times today, huh? The size of the swing spice that's used to make it. You don't really... Look, here's the thing. Do you want to know how to build a watch, or do you want to know how to tell time? That's what you have to kind of decide. I mean, I can tell you, and look, just so you know where it is, just for fun. I put, how is it? So in the glossary of commonly used terms, just so you know where it is, there's an example of what the one-to-ones big swings are. So it's from big trend-changing swings. And then there's an example of the small swing one-to-ones and what they are. Every swing. Seems like we've gone through that a lot today, which is fun. All you have to know is it's a line that you have to watch out for. Okay, guys, tell me the truth. What do you see? Momentum trade or not? You see 50-50? All right. Is it a momentum trade? Or are you waiting for a trend trade? Or are you waiting for no trade? Now, the other thing is you have to go back and ask yourself a question. How good was the bottom? The better the bottom, the more likely it is you're going to get a trend trade long. So watch. Let's just say, look, and I don't care if I lose. Watch. Let's just say I was going to buy one down because I didn't have any other way to get in. Is everybody okay with that? I got one down. Now there's one up. I'll put a stop right behind it. We'll put a target up here. What the hell? I got to figure out where targets are. But do you see how I did that? So because of the strength of these two triggers and being above the midband, the one down is probably all you're going to get because sometimes they're rude about not giving you a trade. The same thing that we saw over here, watch. Remember when we said it was going down for sure and we knew it and we knew where it was going to our fib? And we're like, God dang it, there's no other way to get in. This is where that one up might have got you a trade. You see that? So, again, it's just an alternative way to jump into a market that, you have to, number one, have a really good top or bottom. And then number two, you have to have a lot of strength and momentum. Number three, if you have areas, it makes it a lot easier. Anyway, food for thought. You ever had those trend trades where you just barely miss and you're like, God dang it? Anyway. All of this is predicated on, again, look, it's going to look really easy after the fact. When you say, wow, that was a good bottom. And wow, those triggers really were strong. And usually, after a good bottom, guess what happens? I'll tell you early, these fibs will break when the triggers are strong. Anyway, we did a little momentum, one down type trade. Pretty cool, right? Again, this may not be in your wheelhouse right now, but it's only reserved for after an area is so good and you know it, and there's no other way to get in that you have to resort to this. It's about how it goes. And then usually, as long as the triggers remain strong, this is how you trail your stop. You'll wait for a one down, another one up, and then you'll trail your stop again and again and again and again. And sometimes you'll get, a move like that big. So you get a 20-point S&P move. I don't know, but so if you were in, 2 contracts, you could take a couple $100, be happy right now. Don't really have to risk any money at this point. Anyway, this is just sim, but anyway, look, we spent a shit ton of time talking about this, so you might as well do one. That's a whole trading day's worth of money. You do a 10 lot, make 4 or 5 points, do it on multiple accounts, that's all you need. All right, let me digest what you're saying. Now, it looks greedy to not just take the money up there, doesn't it? I did say that they'd probably break because of a strong bottom. Which so far has held true. Crazy talk, huh? Anyway, $500 enough? You guys want more? We should at least hit that little 1-to-1 up there. This is where we're getting weak on the trigger, so it's probably just about done short term. Anyway. When? Yeah. Well, I already knew they were probably going to break back here. Because after, again, look, go back and watch this video that I was telling you about. When you watch the video, you're going to be like, damn, that's good stuff. Oops, wait a minute. On the user guide, we'll get to it. Okay, hang on just a second. Let's see what we got here. That's just a little 14 pointer. Hang on, I'm going to manage it. That was our 1-to-1s, so damn sure don't want to give up a lot of that money. I'm taking it at the 1-to-1s for 13 points. Anyway, probably keep going all the way up, but 13 points proves the point. So good. So no need to wait for large triggers to break resistance if we have a strong top or bottom. Now, after you have, and again, look, how do you define strong top or bottom? So this is where I went long. The minute you have fibs that hold perfectly and both triggers going up strong, you have a good bottom. So we had a good bottom right here. If that makes sense right there. So now, because the triggers are weak, they'll probably do the same thing they normally do, which is from the 1-to-1 back to the fib, go finish the business, and we'll see. Now watch this. Remember how I said this is a good way to manage your trades? So again, look, I went long. Let's see where the hell I went long. I went long on a 1-down with strong triggers, and I just chose to get out. If I was going to manage with this 1-down, 1-up thing, then my stop would be right here. And I'd be looking for more still. Does that make sense? So again, the triggers probably say there's no reason to get out at this point. It's probably going to keep going. So I gave up money probably, but with only one contract, at some point you got to make your choice. But anyway, the management philosophy of 1-up, 1-down with this look on the triggers says hang on for more because you're probably going to get it. And then whenever they stop out the 1-up, 1-down, it's usually the top. Anyway, for what it's worth. Good bottom, strong triggers. And let me get back to that video because, again, I can give you guys a whole host of videos to watch. I got a list. Let me see. I made a list for you. Video watch list. Again, look, these trades are on the YouTube, so you don't have to do them. But look, these are all trigger line education, Fibonacci areas, course overview, define. This is where it starts right here. Defining good tops and bottoms. And then I have multiple videos. There's 3 more videos right here for good tops and bottoms using the NASDAQ, using crude oil, doing momentum trades, doing pretty much everything. If you guys want that list, I'll give it to you. But I mean, they're all in here, but you got to dig them up. The power of good top and good bottom cannot be understated. And even though you think they might stop, they really don't. They keep going. So I was just trying to take this one out to the end. If I was doing one up, one down, this would be my new stop. Does that make sense? So I bought one down. My stop would be below the one up. New stop would have been below the one up. New stop's below the one up. And you can see we're on the verge here of losing our trigger line momentum. That's probably getting close to making a deeper retracement. And that would be where I'd be stopped out. So I'd be stopped out at exactly the same price as I chose to get out of. You see that? Interestingly enough. Anyway, so I wouldn't have made more money, but I'd had the opportunity to make more money. Now, should still go up. You guys large chart read for me. 1-to-1s at 0450. Tell me about the triggers. Triggers suggest what? We're still going up, yeah? All right, let me give you those videos if you want. There you go. You know, we've said the same thing for so many years. Sometimes it's nice to kind of hear somebody say it in a different way than Mark saying it. But it's the same thing. Strong triggers, buy a pullback. Strong triggers, buy a pullback. If there's divergence and small triggers against you, get out. I mean, that's pretty much it. Yep. Well, the large chart says we're probably going to make resistance. So, which, you know, again, look, when we made resistance the first time, look at the strength of the triggers. It wasn't a mystical, magical call or anything like that. It's just reading the bottom, reading the triggers, saying this usually is what happens as they keep going. So I was able to hold a trade. Remember how I said in the beginning, it's going to be virtually impossible for a new person to hold a trade through that much resistance. And if I was in multiple contracts, I damn sure would have taken half of them off there. And I would have tightened up my stop. But, you know, again, it's just odds and probabilities. After a good bottom and strong triggers, we break fibs. You know, I put that in the video, didn't I? All right, Morgan. Have a good one. And now look, we're reaching resistance. 08, first resistance. First resistance with weaker triggers. So, you know, we're at the spot where they may try to make a stand here. We'll see. Sometimes you get those incredible runs and you're like, damn, are they ever going to stop? And almost all of them happen after a good breakout or a good top or bottom. Like I said, a lot more money to be made after a good top or bottom, usually. All right, guys, I am about done for the morning unless you guys have questions. And if you do, I mean, I'll stick around as long as I'll stay here another hour if you want. If you have questions, if you have charts, questions, anything you guys want to go through, I'm more than happy. Concepts that I confuse the crap out of you, feel free. Purple line. You talking about divergence? Elvis? Very good, Jonathan. I love to hear that. Divergence lines? Yeah, divergence lines are great. But yes, we do have those in all of our platforms. Still hadn't stopped, has it? I'm here every day. I just don't run the room. There's nothing that I said today that's not been said 50 times in this list of videos. There's not one new. I didn't come up with anything new over the weekend, guys. I didn't even think about this room over the weekend. I was like, I'm just going to get in here and do what feels good. So I didn't even have a plan, to be honest. That's a really good question. Let me give you my answer. I have a specific, super specific, very, 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 very well thought out answer for that. I'm going to copy paste it for you. The only thing you have to do is stick to it. It's just the hard part. I'll give you the almost perfect answer for what we do. I mean, for our software, our rules, our plan, and it's in the NASDAQ plan that I gave you, but let me see, where the hell did I write it? Okay. In that NASDAQ plan, so like for me, my daily goal is $800 a contract, which is not that difficult to make most of the time if you're getting the right trades and you're hanging on for your targets. But if you get up 800, you basically have a $200 trailing stop. So if you ever lose $200 a contract, stop. Yes, I'll give it to you again here. There it is. The other flip side of that is, let's say things go really crappy right off the bat, okay, and I lose $400 a contract. So what will happen then, or what should happen, is you stop trading at minus 400, and then you have to assess whether or not you were taking perfect trades without breaking any rules or doing anything stupid. You can say stupid, it's okay. Because usually it's doing something stupid that gets you down $400 a contract. Or something against what the indicators say. That's probably a better way of saying it. But anyway. So what will happen then is take a 15-minute break. And if you traded perfectly, and it just didn't work out, and you followed your rules and it just didn't work out, it doesn't change the odds of what's going to happen for the second half of the day, does it? I mean, if a trade's going to win, it's going to win whether you take it or not. So as long as you were exercising the proper rules, the proper indicator reading, and everything else, it doesn't matter whether you risk another $350 the next day or later that afternoon. I mean, it's the same $350. So if you get back in and you lose another $350, then you got to say, all right, screw it, I'm just off today. So you're basically max risking at $750 a contract if you do everything right, and if you do wrong trades, then your max loss should be $400 a contract, which is really easy to get to, especially on the S&P. Doesn't take a lot to get to down 400. So, again, this is just my thought process on it. And then again, I've been up $800 and given all of it away and then some. So again, this is a rule that's put in here to protect me from me more than anything else. And then, it was a guy, Steve, who lived in Las Vegas, client of ours, had software 18 years. He's like, I don't have a max loss per day as long as I'm doing the right trades and the market's behaving. He goes, because it doesn't matter. It's eventually odds are going to be in my face. It's just like Vegas. They don't close the casino if you win 50 grand. Right? They don't go, oh shit, oh John Novak won 50 grand on the craps table. Let's shut down the old casino. Nope. Keep playing and the odds will end up being in your favor. So again, you have to make sure you have an edge. Make sure you're exercising that edge correctly and consistently. And then, you can give it a little more wiggle room. Yeah. No, they don't. I've done it. And they give you freaking steak dinners and free sweets, and they want you sticking around being happy. They don't ask you to leave. Unless you're counting cards, and it's different, of course. All right. So, anybody have any questions or anything else you guys want to go over? If you do, feel free. If not, I will end up the recording here, and I'll post this